Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ROGERS CORP quarterly report. ROGERS Corporation offers a diverse range of businesses and services through its three main segments: Advanced Electronic Solutions, AES, Elastomeric Material Solutions, EMS, and other. The AES segment provides engineered materials and components for various applications, including electric and hybrid electric vehicles, automotive and aerospace industries, renewable energy, and wireless infrastructure, mass transit, and industrial markets. The EMS segment offers customized silicones and polyurethane and silicone materials for applications such as cushioning and gasketing, sealing and vibration management, wire and cable protection, electrical insulation and conduction. The other segment provides elastomer components, including elastomer floats for level sensing in fuel tanks and storage tanks, general industrial market solutions, under the ENDUR trade name. The decline in ROGERS Corporation's ROG stock price over the past year can be attributed to several key factors: a weak fourth quarter 2025 forecast, disappointing second quarter 2025 financial results, and a 52-week low in January 2025 all contributed to the decline. The company has also faced broader declining revenue and profitability, with revenue decreasing by 14.8% from 2023 to 2025, TTM, and gross profit margin falling. Restructuring and impairment charges of $89.1 million for the 9 months ending September 30, 2025, further impacted its financial performance. Additionally, aggressive U.S. trade policies and geopolitical tensions have caused volatility and contributed to stock drops, affecting input costs and manufacturing operations. These factors combined have led to a significant decline in ROG stock price, exceeding minus 14.8% over the past year. The primary drivers of revenue growth or decline can be identified through an analysis of the financial summary provided. The key takeaways are as follows: revenue growth drivers. The Americas region saw a significant increase in revenue, with a 24.5% growth in Q3 2025. The APAC region also experienced growth, with a 41.2% increase in Q3 2025, driven by China's 9.8% increase and other regions' varying performances. The EMEA region saw a 15.3% growth in Q3 2025. Revenue decline drivers: restructuring and impairment charges increased significantly, contributing to the decline in revenue, with a 1,043.6% rise from $7.8 million to $89.1 million. The Americas region experienced a decline in revenue, with a 4.5% decrease in YTD 2025. The APAC region also saw a decline, with a 14.7% drop in Q3 2025. Net sales were the primary driver of revenue growth or decline, with an increase of 2.7% in Q3 2025, but a decrease of 4.5% in YTD 2025. Net income decreased significantly in Q3 2025, with a decline of $2.1 million, 19.8%, compared to the same period in 2024. This trend continued throughout the year, with a YTD decrease of $66.4 million, minus 83.6%. The main reasons for this decline include uncertain global conditions, trade policy dynamics, and fluctuations in foreign currency exchange rates. Profit margins also experienced changes, with gross margin decreasing from 74.1% to 72.3% in Q3 2025. However, operating margin increased slightly in the same period, rising from 6.9% to 7.3%. In contrast, YTD operating margin decreased significantly, dropping from 5.9% to minus 8.6%. The reduced demand forecasts for the Ceramic reporting unit contributed to the decline in net income and profit margins. The company's performance was also affected by external factors such as trade policy dynamics between the U.S. and other countries, particularly China. Fluctuations in foreign currency exchange rates further impacted the company's financial results. Overall, the decrease in net income and profit margins can be attributed to a combination of internal and external factors, including reduced demand forecasts, uncertain global conditions, and trade policy dynamics. The company's financial performance indicates a positive trend in its operating cash flow. According to the financial summary, the net cash provided by operating activities has been consistently high, with $54.3 million in 2025 and $93.4 million in 2024. This suggests that the company is generating sufficient cash from its core operations to support its growth and investments. The company's debt level and interest expenses have remained relatively stable over the past year. Despite a decrease in net cash used in financing activities from -38.6 to -40, there has been no significant change in the current or non-current portion of debt. Additionally, outstanding borrowings were zero as of both September 30, 2025 and December 31, 2024. Interest expenses have also decreased significantly, with cash paid for interest decreasing from $1.4 million to $0.9 million, a 36% decrease. Finance lease interest expense has seen an even more substantial decline, dropping by 67%. Furthermore, the company has shifted from incurring interest expenses to earning interest income, with net interest income increasing to $0.2 million and $0.9 million for the 3 and 9 months ended September 30, 2025, respectively. Management is emphasizing a short-term focus on cost reduction and consolidation, with plans to streamline manufacturing operations by the end of 2025. In the long term, they are committed to driving growth through market-driven innovation, strategic acquisitions, and operational excellence. Key areas for growth include emerging markets such as EV/HEV, ADAS, and renewable energy. The company expects sufficient liquidity and cash flows to fund operations for at least the next 12 months, with plans to reinvest earnings from foreign operations indefinitely. The company has a history of share buybacks, with a total of $76.1 million allocated for future purchases. However, there is no evidence to suggest that the company has paid out dividends in the past year. Instead, it appears that the company has received dividend payments from its unconsolidated joint ventures. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary reveals concerns regarding inventory buildup or supply chain disruption. Several indicators point to this issue. Raw materials and work-in-process inventories have increased, while finished goods inventory has decreased. This suggests that the company is stockpiling raw materials and unfinished products, potentially leading to inventory buildup. Customer management of inventory levels in the EV/HEV market has resulted in lower net sales due to changing regional demands. This indicates that customers are adjusting their purchasing habits based on shifting market conditions, which can disrupt supply chains. Lower wireless infrastructure and EV/HEV net sales have also been experienced due to customer inventory management and changing regional demands. These factors contribute to the concerns about inventory buildup or supply chain disruption. That concludes the financial summary for Rogers Corp. Feel free to comment below, and I will be happy to answer them when possible.